Hey everyone, welcome back to Corporate Decoder, the place where we decode the confusing world of corporate finance and give you the real scoop. Today, we're diving deep into Gartner Incorporated's 2025 annual report, a document that is packed with numbers, risks, and strategic moves. Get ready, because sometimes the most important decisions these executives make are hidden in plain sight within these filings. Before we get into the nitty-gritty, if you love getting digestible insights from these dense reports, hit that subscribe button. And for those who love a good real-time chat about what these numbers mean, join our Discord community link down in the description. Let's decode Gartner. Alright, let's kick things off with a quick look at Gartner's public standing. As of mid-2025, the market valued their common stock held by outside investors at a hefty $30.3 billion. That is a serious number reflecting significant investor confidence. Now, let's shift our focus to the core of this report. Gartner's fiscal year ended on the 31st of December 2025, and they brought in a total revenue of $6.5 billion. That figure is up 4% from the previous year, or 3% if we adjust for currency changes. That might sound like steady growth, but let's dig a little deeper. Here is where things get interesting. While revenues went up, their net income took a significant tumble. It dropped to $0.7 billion in 2025 from a much healthier $1.3 billion in 2024. That is a 42% decrease. Why the big drop? The report points to a goodwill impairment loss of $150 million. Think of goodwill impairment as writing down the value of past acquisitions because they are not performing as well as expected. In Gartner's case, this loss came from their digital markets business. On top of that, they had a large gain from event cancellation insurance claims in 2024, which obviously won't repeat. And rising income taxes also ate into profits. Gartner operates in three main segments: insights, conferences, and consulting. Their insights segment, which is their biggest revenue generator, brought in $5.1 billion in 2025. That is a 5% increase from the prior year. This segment is all about providing research and advice to businesses. It seems their core business is still strong and growing. The conferences segment also saw impressive growth, with revenues climbing 11% to $644.7 million. They hosted 53 conferences in 2025, up from 51 the year before, and attracted over 83,000 attendees. This suggests that in-person events are back in full swing and contributing significantly to their top line. However, their consulting segment experienced a slight decline, with revenues dropping 1% to $552.5 million. Consulting is project-based, and this segment's revenue can fluctuate. While the drop isn't massive, it is a segment to watch, especially when compared to the growth in insights and conferences. Let's look at a key metric for their insights business, contract value. At the end of 2025, their contract value stood at $5.2 billion, a small 1% increase on a currency-neutral basis. This metric represents the total value of all their subscription contracts. A modest increase here in a key growth area suggests their subscription business is stable, but not experiencing explosive growth. Gartner boasts a client retention rate of 85% for their global technology sales business and 86% for their global business sales. This is a really solid number. It means they're keeping most of their clients happy year after year. However, their wallet retention rate, which measures how much revenue they're retaining from existing clients, dipped in both sectors. For the technology sales part, it went from 102% to 96%, and for business sales, from 106% to 99%. A wallet retention rate above 100% is great, meaning clients are spending more with them over time. So, while keeping clients is strong, getting them to spend more is becoming a bit tougher. This could signal increased price sensitivity from clients or stronger competition. Now back to that hefty $150 million goodwill impairment. This was primarily linked to their digital market segment, which they've since sold. They recognized this loss in 2025, and it significantly impacted their overall profitability. This move signals a strategic shift away from that specific business. Gartner operates heavily online, making cybersecurity a huge concern. They state they have a layered cybersecurity program, but the report also highlights ongoing threats from cyber attacks, including those amplified by artificial intelligence. A data breach or system failure could seriously damage their reputation and business. They are investing heavily in security, but the constant evolution of threats means this is an ongoing battle. Their balance sheet carries a significant amount of goodwill and other intangible assets, making up about 38% of their total assets in 2025. This means acquisitions have played a big role in their growth. However, it also means they are vulnerable to future impairment charges if those acquired businesses don't perform as expected. Gartner carries substantial debt. As of the end of 2025, they had about $3 billion in outstanding debt, including several senior notes maturing in the next decade. While they have access to a revolving credit facility for short-term needs, This debt load could limit their financial flexibility and impact future operating results if they face financial headwinds. In a surprising but increasingly common addition, Gartner also calls out climate change as a business risk. They mention that extreme weather events could disrupt operations and that the costs of green energy might increase their operational expenses. This shows how interconnected global issues are becoming with corporate strategy. So, what is the story here? Gartner is a resilient company with a strong core business in its insights and conferences segments, as evidenced by revenue growth and high client retention. However, a significant goodwill impairment from a past acquisition and increased operating costs, particularly in selling general and administrative expenses, have squeezed their profits. The dip in wallet retention and the ongoing cybersecurity risks are also points of concern. Their substantial debt load requires careful management, while they're adapting to new technologies like AI and even considering climate change in their risk assessment. Their future success hinges on how effectively they can navigate these challenges while continuing to deliver high-quality insights to their clients. A major positive development was their agreement to sell the digital markets business in January 2026, which should streamline operations and remove a drag on profitability. Overall, Gartner appears to be in a stable but challenging period. They are a leader in their market, but they need to manage costs tightly and continue innovating to overcome competitive pressures and economic uncertainties. That is our breakdown of Gartner's 2025 annual report. What do you think about their financial performance and their strategies for the future? Let us know in the comments below. If you found this deep dive valuable, please give it a thumbs up and subscribe for more decoded corporate insights. And don't forget to join our Discord community, linked in the description for more real-time discussions. Thanks for watching, and see you next time on Corporate Decoder.